Okay, I say we get started right about now. So thank you very much for attending today's webinar. I assume that you've read through the risk warning at this stage. So let's just slide on through to the title of this particular webinar, which is non-farm payrolls. It's live coverage. So we've got 10 minutes to go until the news comes out. 1:30 here in London, GMT, 8:30 over in New York. What I want to do here is first just have a quick look at the economic calendar, look at the kind of numbers that we're expecting here, and obviously based on the expectations we can gauge how the market might move given the possible variation from that. So let's just pull that in here. So this is the Lcg Economic Calendar, and so here's the headline number, 180,000 expected. It was 148,000 last week. So with 180,000, it's obviously within grasping distance of that 200,000. I think if it, in terms of the headline number, if it popped above 200,000, you know, that'd be very well received and be a very positive dollar event. If it was above 180,000 but that doesn't quite step into 200,000, it won't be as obviously strong. So you'd imagine dollar positive, but more chance of a pullback quite quickly. And then obviously should it fall into the 160,000 and below, so looking at a kind of 20,000 variance here, it's still going to be better than last month. So while it could be a dollar negative event, it may not be sustainably negative of the dollar. So all that said, relating to the headline number, of course we have the unemployment rate. That's meant to be sticky around the 4.1%. Obviously if it dropped to 4%, that would be a positive surprise, but it would only be a sort of additional subtraction from the main consideration, which I would say is probably not the main headline number. It's more about this this earnings growth. So this is the annual growth, which probably is the best gauge, but actually most people focus on the month-to-month data, so 0.3% month-over-month gains. The reason for this being potentially the most important piece of the data set here is that why have markets sold off this week, right? Well, you obviously can pinpoint all sorts of explanations. We're pretty overdue a pullbacks, the end of the month, profit taking, etc., etc. Obviously, this pullback in stock markets has coincided with a sell-off in the bond market. And why are bond markets prices falling? Why are bond market yields rising? Well, one thing is that inflation expectations have picked up a bit. So if you look at, when we're talking about longer dated bonds, they basically move up in yields if there is an expectation that inflation is going to be higher in the future, and obviously you need a higher yield to overcome that inflation and still make a return. So basically, obviously, inflation expectations picking up. If average hourly earnings, basically wage price inflation, picks up more than expected, so even just 0.4% on earnings, I think that would be a naturally very dollar positive event, and I think perhaps would add to the sell-off in the stock market if we get a 0.4% on the average earnings. So let's look out for that one. That could be a clue if you are looking directionally to play the Wall Street or SPX 500. They are considerations. Should say, of course, at any point, if you have any questions on this stuff, let me know. So I think that's the numbers just about covered. I'm going to try and pull the numbers live on the screen as they're released in about 6 minutes. After the release, we'll discuss how they look, and we'll see how the market's reacting. But let's try and bring in the LCG trader here, and have a little look at what we're dealing with in terms of the price charts. So this is Wall Street. So it's a daily price chart, and you can see we're basically sitting on this support here. This, to me, would be the first natural layer of support, and you can see that we kind of dipped down there. We tried to close above it, barely did, flat for the next day, and today we're rolling over again, and we're pulling back to this little swing low down here. You can see where it had a higher close on either side, so it's a little swing point, and obviously down below there we have a more significant low. If I can draw it in, placed in at this level. But if we get something dramatic here, it could take us through these levels. But do remember again, always the consideration with NFP as it is at the end of the week as well, which is a significant kind of factor for stock markets. Obviously, you see the move and then you kind of take profits and leave for the day kind of phenomenon, or you're closing out your trades for the week, so you don't have any weekend risks. So the fact that it's a Friday does make a difference. So these are the kind of levels we're looking at. How is the short-term chart setting up here? Let's have a look at the 30-minute chart in Wall Street, and I'm hoping we'll have some time to digest the dollar yen and gold as well, which tend to be quite good markets. These lines, Harvey, are purely support and resistance. So obviously, you can draw fibs separately. I haven't actually drawn any particular fibs on these. So for me, if I'm looking at fibs here, I'd probably start at this little swing point down here. You could potentially go up here, but I would say we're probably through all the significant fib levels of this, starting at this level. So I'd either start here or maybe down here at this correction. So if we were to draw any fibs on top, I'm not sure if there's anything that corroborates what we're looking at here. The fibs kind of fall in between our levels, but certainly the 61.8 adds to this kind of area as a zone of support, I would say. And then if we stretch it out a bit, does that give us anything more substantial? Brings us to this peak down here pretty perfectly as the 61.8. Then if I drop in the 50%, the 50% drops nicely in and around that support level there. So we do have a confluence of support down here at the, what is that level exactly? Here, 25670, let's call it. So certainly a consideration. Basically the idea here is what we're trying to do is determine the overall direction of the trend. To me, it's still up. So we're looking for potential pullback levels for this little correction that we're seeing to end. Obviously, we are toying with the 20-day moving average for the first time in a while, but on previous occasions, it hasn't really done too much when we have tested it. It's just been a reason for pause before the market picks up again. So that's what's happened recently. Obviously, the past is not a perfect guide to the future. But if we drop down to this short-term chart, maybe a 15-minute chart, you can see this is the kind of range we're dealing with. So if we're expecting some sort of end-of-week recovery, we're obviously looking for the price to break through the top of this range here. So 25994, we're basically 26,000, isn't it? Basically, is there are probably going to be some buy stop orders above 26,000. Now, if we get some solid data that's positive for the market, then obviously those buy stop orders they could work out. The risk is if we get something a bit wishy-washy, we could get an initially positive reaction which sucks up all those buy stops, and then we see the market sell off again back into this range and maybe even taking out new lows. The bottom of the range, obviously we've got that low from yesterday, but really what we're dealing with is maybe a slightly sloping range, or if you wanted to be a slightly more conservative as a horizontal level, it's probably down here is where any kind of sell stops might be that are trading on this data. Maybe slightly more aggressively they'd be here. So this is the range we're dealing with. We've got a preceding downtrend taking place at the moment. So obviously, just popped out the top of that range. Data's coming out pretty quick. I've been jabbering along. We haven't got a chance to look at the other markets. Markets moving a bit in anticipation of the data. Let me bring in the news feed here. So we've got stocks on the screen. We're breaking out to the top side pre-data. This could be a little stop run before the market eventually heads lower. Let's see. Stocks acting positively, dollar mixed according to this headline. Let's see what we get. Looking like a breakout here. Question is whether you follow it or not. Pre-data, it's risky. Maybe some people have some inside information. They're buying into it. Or maybe this is just sending people the wrong direction before we go the other way. Got Chevron data. We must be getting the news pretty soon. What's going on? Oh, here we go. 200K, good data. Average earning earnings 0.3% as expected. Unemployment rate 4.1%. False break as suspected. Popped high before the news. We're heading lower. We're heading lower in the. We're heading lower in stocks. You know, we're continuing the existing trend. It looks like. But is this really that bad? The December payrolls revised to 160K. Now revised to +2. Well, that's a really good positive revision. So these are generally pretty strong data from what I can see. Private 196. Well, plus 200K, and the wage growth looks all right. Year over year, 0.9%. I mean, maybe that's the worry for stocks as I was talking, is that, you know, that 0.34%, it's obviously slightly ahead of the 0.3% consensus on wages. So there's that inflation factor coming in. Let's see how the dollar's moving. Dollar yen looks positive on the day. How are we reacting in the short term? We've had a spike in the dollar, so obviously it's that wage data, as I mentioned, that seems to be the critical factor here. We've broken out of this little flag pattern dramatically to the top side. We've flown through 110 in dollar yen, but there could be some selling up there in 110. I mean, it's generally positive data for the dollar. It's hard to find any particular negatives. We get higher revisions for last month. This month beat expectations, higher wages. It's all pretty dollar positive. We're up to those. We're up to 110, we're up to that previous low. If the downtrend is going to roll over again, it would be from these levels, from this previous support turned into resistance. My suspicion is we can push a bit further from here, though. It looks like we may be in for a bit of a dollar recovery. We might be able to get up to 111 on this. Let's see what the euro's doing. Presumably it's heading lower. Not quite as dramatically as dollar yen, but it has broken lower. This could be the straw that breaks the camel's back in terms of 125. We basically have failed to break out through 125 here, and we're making a couple of days low here in the euro. So signs that NFP may have caused us a top in the euro, a little recovery in the dollar. It looks like. How's gold doing? Presumably it's heading lower. It is. And again, this breakout, if I just pull us out to the weekly chart, we've got this big breakout that we're trying to do above this declining trend line in gold, and this may make the difference for whether this week closes below this trend line and whether in fact we end up holding this same old range and heading lower again in gold. Let's have a look. We're definitely heading lower, not too dramatically lower in gold so far. Maybe supported by the fact the stock market's going down as well is why gold is doing okay. Let's have a look. It's definitely heading lower. We're about, let's see, $6 odd lower in gold. Not too dramatic. You know, there might be some dip buyers that come in down at these previous lows down here. If we are able to get down to 1337, I wouldn't be surprised some people tried to buy that up towards the end of the week. This is on the whole positive data. Does it change how often the Fed raise rates? Probably not, but I would say it probably we had slightly hawkish minutes from the last Fed meeting. Sorry, a slightly hawkish statement from the last Fed meeting. Probably increased the chances of a March rate hike, and this again does increase the chance of a March rate hike. So from a dollar perspective, pretty positive stuff in general. Obviously, we have been selling off in the dollar this week, so you know, this is sparking a bit of a recovery. In terms of what are the dots on these candles, someone's asked, Brian's asked. They are fractals, Brian. So if you're using this LCG platform, what you can do is if you go down to right-click, go down to indicators, and then if you go down to other and scroll down here, it's that one, fractals. What you don't have to use them, of course, but I kind of like them because they, for me, designate swing points in the market. So basically, you see this low here and this low here. They've got two higher lows on either side, and for the peaks, they've got two lower highs on either side. So it's a day that's had two lower days either side of it, kind of noting an up movement, a crest, and then a down movement for the peak, and then obviously vice versa for the bottom. It gives you a little sense of the an additional sense as to the trend of the market. Stefan's just asking about that news feed that I've got. No, that's the Dow Jones news feed. Let's have a look. I think our platform probably, our calendar does update pretty quickly, all the numbers in there. So here you can see the 200,000 is confirmed. Average hourly earnings on a yearly basis, obviously, yeah, so that's quite a big beat on the yearly basis. So the month-on-month data was as expected. It was 0.34%, but actually when you factor in it on a yearly basis, it's quite ahead of expectations. And if you're transplanting wage prices straight into inflation, I mean, in terms of what the Fed aims for, they aim for 2% inflation, and wages are growing at 2.9%. So obviously they're a real positive pull on inflation at the moment. Let's see how we're doing on Wall Street. So we're still hovering around the bottom of this range. So perhaps this end of week phenomenon kicking in here. With the dollar, it's all fairly straightforward. It's dollar positive, this data. Whether it holds those gains or not, we've been in a dollar downtrend. People may be tempted to sell this news release. And it seems like a decent risk to reward for doing so in dollar yen. But after like a solid move like that, it is the first real bounce we've had off the lows. So first bounce before we finally bottom out. People sold this little bounce down here, but it's hardly a bounce. This is much more solid. I wouldn't be too confident in seeing new lows from this, but it is a potential selling point up here. 110 as a round number, and the old lows, potentially an area that people sell into here, but I think maybe we've seen a bit of a bottom in the dollar. It looks like for the time being, especially if you look at the fact that we've basically hit the bottom of our range in dollar yen, and we hit those big levels. Here's cable falling away from that 143 mark. Could be interesting if we get a bearish engulfing candlestick pattern here on the daily chart on cable. That would be an engulfing pattern near a double top scenario around that 143 mark. Could be interesting, could spell more weakness for sterling. And euro, as I mentioned, pulling back off those lows. I mean, this is tricky here because we're in an uptrend for the euro, but it does look like we're struggling at 125 a bit. Obviously, we're getting some people bouncing the off the bottom of the news release here. Wasani's asking how this affects pound yen. Well, it doesn't directly affect the pound or the yen. Obviously, it's affecting the dollar. So then the question is, which is the bigger impact, the weakness in pound dollar or the strength in dollar yen? Dollar yen tends to overpower pound dollar when it comes to expectations about US rates, which is kind of how people are reading this inflation data. So I would say probably it's, let's have a look at pound yen. Have I got that loaded up? Let's have a little look here. I don't, but let's do it. So as you can see, kind of mixed because obviously got those two competing factors. But as I said, it's that dollar yen side of things which seems to be contributing more to. I want to put it onto the daily chart. How do I get it lower? Dollar yen, unsurprisingly, kind of the bigger factor than the pound yen weakness. The dollar yen strength more of a factor for pound yen. But obviously pound yen's been in quite an uptrend. You know, the pound has been quite resilient, but if pound dollar falls off, a lot of the crosses tend to follow suit. So potentially looking at 156.50-ish as a tipping point here in pound yen. Yes, good question, Tony. Tony's asking about Wall Street. How do I expect to move from here? I'm actually writing a report at the moment, just generally about the dip we've had in stocks this week. So obviously I don't have a crystal ball. If we pull out for a sec here in Wall Street, the fact that we're holding the lows at the moment is a positive sign. We've had a bit of volatility, a bit of weakness this week. Do people buy the dip at the end of the week? Distinctly possible. Depends if we get any decent earnings, probably. But bigger picture, this is Wall Street. So we've pulled back about 3%, so 800 points out of a high from 26,700. So 3%, you know, it's a reasonable-ish pullback compared to what we've witnessed recently. So recent experience would suggest this is a dip buying opportunity, and the market moves to new highs. Now, I would caveat that with the fact that that has been happening all the way through, and eventually that has to not be true. I'm watching these support levels that we previously referenced. If they give way, I'm going to have more belief that this is a more long-standing correction, that we're heading a bit lower, you know, down back towards the 25K level, which is obviously the big round number, and just a bit below it is about 24,900, where we kind of paused down here. If we are to see a bigger correction, those would be the levels I'd be targeting. Why could that happen? Well, if you just look at what's happened recently, we're up about 5%, pre this, still about that. We're up about 5% in the S&P 500. That's pretty similar for the Dow, I think, for Wall Street, in just January alone. So in January alone, got returns of 5%. I mean, there's many years where you won't get 5%. I mean, the average return over the last 10 years, I think, is 8%. So you've made a good bulk of your average annual return in just January. So obviously profit taking is going to be a very tempting thing, and that's kind of what we've seen in the last few days of January and the first couple of days of February. We've seen profit taking coming in, so that's natural enough. The other thing is that we've been ramping really seriously higher because of positive expectations for US tax reform, and potentially infrastructure spending as well in the US. But I would say that's priced in at this point. So if you're looking further afield, we've had this rise in bond yields. Inflation expectations picking up. That means the Fed might raise rates more. They'll be shrinking their balance sheet later on this year. Central banks as a whole, like the ECB, the Bank of Japan, and the Fed, will all be shrinking their, the total supply of bonds that they buy will be going down for the first time in multiple years. So you haven't got that central bank support anymore into the middle of the year. So it's a few things in the back of people's mind as to why this could trigger a bit of a risk-off scenario, but I don't think we're quite there yet. My default assumption would be to say it's a dip buying opportunity, but I can see the risks on the horizon as to why it's not. Best thing is to watch these price supports. If they give way, then play for the bigger correction. At the moment, it looks like it's holding these supports, and that's more of a place to buy the dip. In terms of the dollar, I mean, I'm generally fairly bearish the dollar, but it's had quite a hammering so far this year. As the stocks have been flying higher, dollar's getting slammed, so it is due a pullback. Dollar yen, I mentioned in the I did say in the Monday webinar, the market analysis webinar, I said dollar yen probably has the best chance of a rebound from here. And that rebound pulled off really nicely from this level that I've had still. This was what I had in the Monday webinar, and it's bounced pretty perfectly off there. is just because it's in a range. So it's bouncing off the bottom of the range. With these other pairs, they're in an uptrend. So it's a bit less tempting to buy the uptrend until we see some really big completed reversal pattern, for me at least. You know, these markets are still trending higher there in general. So I'm less tempted to sell them. And so these markets, I would say, more chance of just a consolidation before another push higher. Right, so I think I'm going to call it a day there, chaps. I hope some of you are able to ride that positive dollar move, that move in stocks lower. Have a look for the rest of the day if you are still trading on Wall Street, because it looks like we're holding the bottom of the range for now. That might not last. Oh, we actually, look at that. Even as I'm talking, we're actually breaking. So look at this. So we had a classic false break to the top side, rush down to the bottom of the range. That range that I pointed out literally has been just the perfect a perfect place for just kind of running stops either side. I said there'd be buy stops up here. They got ran, sent it lower. There were sell stops down here under this level. They got ran, and now we're pushing higher again for that potential end of week dip buying, longer term dip buying opportunity. So at the moment, looking at this candle on the 15-minute chart, that looks fairly positive. It looks like we're pushing out. So be wary of this consolidation area over here around 2690-ish is where we had a cluster of these lows up here. So maybe that's where we stall out around the end of the week, but we gain back some of those losses. Beyond there, it's this sort of 26,150, which is these two peaks here. So this kind of consolidation area is probably where this rally, if it does have more legs, can stall out. All right, thank you everyone. Thanks very much for attending, and catch you hopefully in the Monday webinar next week. Cheers. Jasper signing out.